Finally, we arrive at the place where, at the time where we have a calculator, we'll have numbers, we'll have more, less emotion, less speculation, and now we think about buying a business, not a stock. And I've put on screen different companies that Buffett has been involved with and is still involved with. American Express, Heinz, Coke, IBM, Gillette, Fruit of the Loom, Geico, Dairy Quest. Now, if I was to tell you that you were inherit 1,000 stocks of each of those companies, big, huge, yes, American, but they are doing business obviously worldwide. And if you were the owner of those business, if you were the 1,000 or 10,000 shares of each, and you feel good because those business, and those business have a mode. Those businesses have an endurance. They have been through the stress of time, and they are doing sometimes good, sometimes great, but they are household names that they renewed themselves. So we go back more about the idea of why to buy a business and not a stock. And it goes back to Buffett and understanding what he was doing, and it goes back to Buffett studying with Benjamin Graham and reading the book The Intelligent Investor. And he wrote a letter to Benjamin Graham. It was in July 17th, 1970. And regarding the Graham's work and that particular book, he says, prior to that, I had been investing with my glands instead of my head. Another way of saying that he was taking with his emotion, his gland, his amygdala, his fearfulness. So instead of using his head, another way of how it's important to be rational. So the intelligent investor, he still is the big, he still thinks and recommend that book and thinks that it is the best book that has been written on investment to this date. So again, that goes with it. Investing must be rational. If you don't understand it, don't do it. And when I read that, I think about all the crisis that happened in the 2008, and at the Caisse de dépôt et placement, and everybody that went into the different type of deals they made. And I'm not completely sure that everybody involved exactly knew what they were buying. If I would have to ask everybody if they knew exactly what was it. They maybe just look at the ratings and stuff, but did not completely understand what they did. And sometimes, because men are men, we don't like to say we don't know. We want to fake it. We want to be up. It remembers me. I remember a time I was working for a big bank. We were 45 investment specialists around the table, and there was somebody came from Switzerland. And he came to make a presentation, and he was nice suit and nice presentation, nice demeanor. Everything was nice and professional, but I did not understand some of the things he was saying and he was referring to, but nobody left the hand, nobody asked questions, so I let it go because I was just at the bank for the last 3 or 6 months. So you take your, you don't stir too much trouble. But then at the break, I went out and asked 3, 4, 5 colleagues, just like that. So did you understand this part? Did you understand this part? And to my surprise, nobody really was able to understand, and they all found a way to deviate the question, not to tell me they did not understand. So at that moment, I realized that it's not because people don't ask questions. That's not because people just head nod and that they understand. I see that in my class all the time. So I try to teach the best I can to give examples, but sometimes when I turn the table, turn the mic, and try to re-explain what I just did, I see and I can feel that the person has not completely understood. So that's very important to me and to Buffett. And if you don't understand it, don't do it. And if you don't understand it or believe in it, don't sell it, even if you have pressure to do so. I've done that at the beginning of my career. I'm not proud of that. It happened a couple of times. I was all in good faith, but I was not sure. I did not do my due diligence. It was some investment I sold, and to this date I regret it. So it has not happened for a long time, but enough to. It was a slap on the wrist. All right. The only two things you need to know before you buy a business is pretty easy, and it begins with what stock to buy, and then what price to pay. not the other way around. You don't go and buy because it is on sale. And the example I always take for that is at one point, a friend of mine phoned me and says there was a sale at the Mercerie pour Hommes, the place where you buy suits. But I was living in Saint-Georges-de-Beauce, a small town of 30,000 people, and it was at the center, downtown, and small place. And it's very rare that a guy calls another guy to say, "Hey, there is a sale. Do you want to go with me?" But it was a 50% sale on suits. So I said, okay. Went there, and yes, there was nice blue marine suits, black suits. So I don't like to shop. So I was okay for the next 3 to 4 years. I bought many. I saved tons of money. And because it was very, very clear in my mind what I wanted, it was very, very clear that I wanted classic suits that will stand the test of time. And the price I knew, if we know, we tend to know the price of a good suit, and when you see a good price you jump on it. I made sure there was no hole, I made sure they fitted me, I made sure there was no defect and stuff like that. But once everything was okay, you just go and buy. It's easy. You understand that. There is nothing to it. But when I was there was like white shoes with a little dingle and a little thing on the top. There was a Hawaiian shirt, and there was, because summer things were coming in, there was some caps, and there was some camisole with sleeveless stuff. And I said, no. So I didn't buy the whole thing. Even if everything was on sale, I didn't buy everything. And some suits were not black or marine. They were a little bit crazy looking. So I just bought what fits me, what suits me, what I knew. And I don't think I'm teaching you anything here. But what happens is, when in the stock market, we don't think like that. We buy because it's going up, and we sell because it's going down, and we are following the price, but you are not thinking about the company. So when you think about the company first, and let's say you think Royal Bank, because the thing we know is the financial institution. So you think about the Royal Bank. So the Royal Bank is a good bank. It's a big bank. It's been around for a long, long time. It has a nice place in Canada. It will be here for many years. And in 2008, 2009, Royal Bank was on sale for more than 50%. The stock went down to $28, $29. So if you are in the market, like for the suits, but you are in the market for good companies for the long term, and you see a Royal Bank at 28, and you know it was worth 56 a month, 2 months ago, even if the global economy is going whack, you have your index chart, you know it when you see a good deal. But at the beginning, you begin with knowing the fact what you want to buy. So that is exactly what it means. I promised you earlier that I will use the Warren Buffett's example of his pinball machine. Now is the time. So I've put some clips here of people, the paperboy. When Warren Buffett was 13, I told you he was going door to door with having money from the newspaper. And he saved at the point he had $35 to invest into a business. And what he did with the $35, he just bought a pinball machine. And he said, that machine, it's fun because the machine, you put money in, you take care of the machine, and then the money is yours. So he bought the machine, and then he was with the problem of having, where do you put it? You have to put it where there is some traffic, there is some people coming out. And he saw that if there was a pool room there, and there was some pinball machine right there, he was sure he would be able to put his machine in the pool room. But no, it didn't work that way, because there was some kind of a hold of that place, and people didn't want him to have competition, to be a competitor. So, but he looked, he spotted, and he observed, and he saw that people going to the pool room that were playing with the pinball machine were all men. And all those guys were having crew cut, the crew cut. And the crew cut, there was a couple of barbers in town that were doing exclusively crew cut. And the nice thing about the crew cut is, after 3-4 weeks, 6 weeks stops, you have to go back because the hair grow and it's not a crew cut anymore. So he went to a barber, and he asked him if he wanted to let him put the pinball machine in his place, in his barber shop. He said, "Yeah, okay, for sure." And he offers the barber, I will take care of it. I will have the maintenance and stuff, and the money we take in, I'll give you 20%, and I keep 80%. Sounds fair. And that was real. It is real for it happened. So the first day, they put the machine there, and after one day, Buffett discovered $10 in the machine. So there was $10 and 10 cents and 25 cents, $10 worth of change. So he gave the $2 to the barber, and he kept $8 for himself. Now we will look at that. Okay, so his income statement day one revenues were $10, expense for now $2, net income $8. We do his balance sheet. And by the way, you may smile at that, but just add zeros and think about making iPhones, and it's the same concept. So the balance sheet, day one, cash $8 in cash. Equipment, the worth is it's not amortized yet, $35. Total assets is $43. He had no debt, of course. Stocks holder, because he put his money in, $35. We'll say it was an initial offering of 10 stocks. It's funny enough. And then retained earnings, though, because he had made some profit, retained earning of $8 to give you a $43 of liability and stockholders' equity. Simple enough. The fun part is when I am in my classroom and I have 35 or 15 or whatever student, I ask, so what is the worth of that business? What is the worth of that business? Would you buy it, and what is the worth? How will you calculate the worth of that business? And then I let people go. I cannot do that now because you're online, you can play pause and you can just... But it's a fun thing because many questions arises. Many questions arise. Okay? But think about it. Ponder about what is the value of a business like that. And it's all about the production. See? And we say there is income of $8 in one day. The equipment is $35. The book value is $43. So is the company worth at least $42? I think it is, of course. Is it worth more? We'll see. So if we take the assumptions, okay, $8 per day, 5 days a week, we give him 2 days of rest at the barber, 2 weeks of vacation. We're a little bit stiff about that. That gives us 250 business days a year times $8 a day. That's $2,000 of net income. So that's our premise. So what's a business that is going into $1,000 of net income? What's it worth? And now when we are in class, discussion continues. Is that worth at least $2,000? Man, so of course, it makes $2,000 in a year. So if I pay it $2,000, I will be repaid within a year. Is it worth $4,000? Of course. Is it worth $10,000? And then we have the fun of going back and forth. But then we have discussion. Yeah, but what if a competitors come in? What if the barber doesn't want to have a pinball machine? What if the barber puts his own pinball machine? And now we have a discussion about the margins, the competitors, and stuff like that. So it begins to be very interesting. What happens to the profit? What if a competitor arrives and say, I will put a pinball machine, a newer one, and instead of giving you just 20%, I will give you 40%. What happens to his business model? So we can see disruption in the business model. We can see many things. What happens if the pinball machine, after 6 months, the people, they don't play on it anymore because they are tired and it's always the same game, always the same customers. They come back and back and back again. And after 6 months, they don't want to play because it's the same game. So you have to change the equipment every other month, every 6 months. So it's not just $35, but you have to put in $35 more every 6 months to change the pinball machines, to have new games, and you have less margin. So you have but we continue on that model, but you see how something as simple as a pinball machine with cents and dimes and just the one location, how it can become something that is challenging in today's world, in anybody's world. So if we look at it from, I would say, the street, from the stock exchange value, the book value is $43, we saw, divided by 10 stocks. So the book value is $4 a share. The earnings per share, we'll use all of that later on. The earnings per share is $2,000 a year, divided by 10 shares. So the earning per share is $200 a share. So according to Wall Street, right now on the stock market, we pay as a ratio of a multiplier of the net income, we pay about 25 times the net income. So if that was true for our company, we have to pay income tax. I haven't figured out the income tax on that, but just for the, we have fun. So 25, if it was a ratio, a PE ratio of 25, 25 times 200 will be $5,000 a share, and the book value is $4. So it goes to show that the book value sometimes is just an idea, but the way we value businesses is not by the book, it's by the ability of the business of making money. Of course, if there is competition and instead of doing $2,000 a year, it goes back to 1,000, and on that 1,000 we pay income tax, and it is just 700. Everything and all the matrix changes, and if we see that within 2 or 3 or 4 years, the cost of replacing the pinball machine is too high, and it can go down, and we can even have a loss. But you understand the dynamic behind that. You have the machinery, you have the income, you have the expense, and then you have the multiplier. Right now it is 25. We'll go more in depth about that later on.